Corporate finance practice problem using OneNote. Rights offering impact on asset position. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, then down in 1725, Rights Impact on Asset Position tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will be down in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have the information up top. We have then the calculations down below. This is going to be another rights offering type of problem. However, this time we're going to be focusing in on the situation of a shareholder and what would happen to their portfolio in general if they were to exercise or not exercise the right. Note that if you want to look at the rights offering in general, take a look at a prior practice problem where we go over kind of the basics of it. But the general idea, corporation wants to gain capital, wants to get capital. How can they do so? They want to issue the shares. Shares are already outstanding. They might then want to get a benefit or the option for current shareholders to purchase more shares at a discounted price, possibly being able to do so through the issuance of a rights offering for that discounted price to the current shareholders. So we're imagining here that we are a current shareholder. We got kind of a simplified type of situation for it, or a fairly basic type of situation, so we can zero on what the impact would be with relation to these rights. Now remember, as the rights are being offered, you have this window of the rights are going to be offered until the point in time that it's closed and you can no longer basically exercise the rights. We as the shareholders then are thinking about, well, what's this going to have an impact on our asset value, whether or not we should exercise the rights or not exercise the rights, what's going to be the impact on our portfolio. So let's think it through here. We got the shares that we own. We're going to say that we own 3 shares. We have 3 shares before the rights offering takes place. We have the market price. This is going to be the market price before the rights offering. It's going to be the $80. We expect after this is all said and done that market price per share will go down slightly due to the fact that they have this discounted price. So the money that the corporation is going to be getting, which will increase the value of the corporation, will not quite equal the market price. So you would expect then the price per share to go down. But we as a current shareholder could either purchase the stock at the discounted rate and have more shares, or possibly get money for the right itself as we go through this rights offering process. So the rights offering, then we're going to say that the rights per share are going to be 1. We have 3 shares, so we're going to get 1 right per share. That means we're going to get 3 rights. The exercise or subscription price, meaning if we were to exercise these rights, we would have to give the rights and the dollar amount of 64, which is of course a discounted price below the current market value before the rights offering took place. And then the rights required to purchase 1 share at a discounted price are 3, meaning we would have to cash in 3 rights, which is total rights that we will have because we only have 3 stocks and we got 1 right per stock. So we'd have to cash in all 3 of them and then pay the $64, the discounted price, in order to get the 1 extra share. The cash on hand, we're going to say 64, and that'll kind of simplify the problem, because if we then take advantage, we're going to pay the exact amount of the 64, which is the cash that we have on hand. Or if we don't, then we might get some cash basically with regards to the right itself. So let's think about how this would happen. We're going to start with the value of the portfolio at the starting point. Beginning before this whole rights offering took place, we had shares of 3 shares. The market price was 80. 80 times 3 is 240. Let's plug it in the calculator just for the fun of it. 80 times 3. The calculator's up there and wants to do something. There's the 240. And then we're going to say the cash is going to be the 64. So we're going to add the cash to it plus 64. We got the total assets of the 304 in our nice simple little portfolio here. And so the next thing we're going to say, okay, now the rights offering is taking place. So what's going to be the value of 1 right? So now we're sitting here going, we got 3 shares. They're going to issue this right, the rights offering. So now we want to try to think, well, if that happens, now we're going to get this right, and you would think that that's kind of tied to the share in essence. And now you can think, well, how much of the value that we have is tied to the right versus the share? Because the right itself we could think of as having a component of the value. So at this point in time, which is the right value, we're going to calculate the value of one right. Remember, it takes 3 rights in order to purchase a new stock at the discounted price of the $64 during the cum rights period is calculated as stock price minus the rights subscription price per share divided by the number of rights required to buy 1 share plus 1. So calculating that out, we're going to say, all right, the stock selling for is on $80. So we have the $80. That was basically the beginning price. The subscription price, meaning what we would have to pay in the discounted if we were to cash in the rights of the 3 rights, 64. The difference between the two is 16. We're going to call that the numerator. Denominator then is going to be the rights needed for 1 share. We'd have to cash in all 3 of our rights in order to get that 1 extra share at the discounted or $64. And we're going to add 1 to it as the equation says up top. 3 plus 1, that's going to be 4. And then numerator and the denominator, we got the 16 divided by 4. Really nothing to do with the calculator here. The calculator's getting bored, but I'm going to plug that in. 16 divided by 4, 4. There we have it. So the value of 1 right, we're going to say is 4. Now we're going to get 3 of those. We're going to get the 3 rights. We're going to say the value of 1 right is 4. So now we want to think about the diluted value, the X rights per share. So we're going to say then the market value is $80. So there's going to be our $80, and the value of 1 right we said is 4. So the value before was the $80, and now the right's worth 4. So we're going to say that the diluted value, the X rights per share, we would think then being the 76 at this point. So now we've kind of broken out when we thought about the price before between the value of the new share, of the share that we currently have. So we're taking one of these shares at the $80, right? And we're thinking, okay, now since they gave me a right, we can kind of break that value up between what we would think about between the value of the stock itself and the right. We would think that the stock itself would be lower because we know that after the company exercises these rights, they're going to get cash that's going to be equivalent to something lower than the market value. So you would think then the value per share would go down, but it should kind of even itself out in a perfect world, right? Because we have the right, which would kind of equivalate that out, which we could use to then purchase the stock and have another piece of stock at the 64, or we can then possibly get cash for the right itself. So let's take a look at the portfolio value if participate in the rights offering based on diluted value X rights stock price. So what if we were to take our rights and purchase the stock? What would happen? So we'd have the shares now. Now we'd have 4 shares because we started off with 3. We purchased the 1 share by cashing in the 3 rights and paying $64. That would give us 1 more share at 4. We're going to say the diluted or X rights price is now going to be the 76. That's what we think the value is after we purchased it. We purchased it for 64, but we think that's the discounted price. We think the value, the market price then, or the X rights price, 76. So 4 times 76, let's plug that in the calculator to give it something to do. 76 times 4, that's going to be the 304. So the 304, how much cash do we have on hand? None, because we paid the $64 in order to exercise the right paying 64 and giving the 3 rights in order to get that new share of stock at the discounted price. That means that we are still left with the 304, which makes sense. So that should give us put us in the same spot that we started out with when we had the 3 shares at 80 plus the cash of 64. Our portfolio is different here because now we have stocks and no cash, but hopefully the value is basically the same. What if the portfolio value, if they sell the rights and keep the stock at the diluted value? So what if we just said, nah, we're not going to buy the new stock. We don't want to pay our only $64 here. So maybe we could sell the rights, and that would result in us having a stock, the 3 stocks, but they would be a little bit less in value, but we would be compensated with cash than for the rights themselves. So in that case, we're going to say, all right, the shares owned are 3, and now they're not worth $80 anymore. They're worth $76. So 3 times 76, same 3 shares, but now they're only worth $76 due to them diluting, in essence, the shares themselves by issuing shares and getting money into the company less than the market value of the shares. So that means that the stock value is about $228. Then we have 3 rights that we're going to be selling. Now the sales price we said was $4. So we might have the sales price. It depends how it works out. If you in some situations, if you were not to sell the rights, then they may just basically give you the rights of the price of the $4 for them, or you can sell them possibly for the $4. And in that situation, the 3 times 4 would give us the $12. And that might be called the nil paid price if you were to just basically let it expire. Sorry, I kind of bounced around there, but we got the 3 times 4 is 12, and then the 228 plus the 12. So let's add that to our calculator. 12. That's going to give us then the 240, and then we have the cash on hand, which is going to be the $64 that we haven't spent because we didn't buy it, we didn't exercise the rights. So we still have that $64 on hand, plus the 64 once again gets us to that 304. So theoretically, we're at the same spot here, although again, the spread of what our assets are now different, because even though we have the same 3 stocks, they're going to be valued slightly less due to the dilution, but we've got compensated for the value of the rights that we basically could sell then at the $12 to get us back to the 304, and then now we have cash on hand of the 64 plus the 12.